Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So stock markets have had a huge run-up, pullback here as interest rates surged a little bit of a bounce back, but I wanted to talk a little bit about the rate environment and the housing market today. So first point today, today's housing boom, very different than 2007. A lot of concern about the run-up that we've had and the fact that prices remain high, even though interest rates are higher. One of the reasons also, most U.S. homeowners are not feeling these high rates, right? We'll talk about the discrepancy between what rates most homeowners have locked in versus what rates we're currently seeing north of 7.5% right now, highest in more than 2 decades. And finally, cash. Big year last year, obviously, as interest rates have gone higher. This higher for longer narrative for the Fed funds. What does that mean? Well, if you're looking at the fixed income asset class, cash, typically thought of as a defensive part of the portfolio, still looks very attractive from a risk reward standpoint when you compare it to the rest of the fixed income alternatives. So today's housing boom is very different than 2007. And here's one example of why. So on this chart, we have mortgage originations by credit scores in billions of dollars. And you can see you've got 5 different categories. In the dark blue there, you've got below 620. That's a really low credit score. And then on the opposite end of the spectrum, we have the light blue above 760. That's a really good credit score. And then you have the 3 ranges there in between. So take a look at mortgage originations based off credit scores. And one of the things you can see, number one, you can see the big pickup in mortgage originations between 2003 and 2007. You see the similarity between 2020 post-pandemic and 2023, the start of this year. 2 big spikes. What's the big difference? Take a look at the credit quality of those loans. Back during the financial crisis, we saw a huge pickup in the subprime market. You saw that mid-tier between 620 and 759, a majority of the applications and originations at that point. This time, very different. Much higher credit quality loans, whether it be refinances or new home purchases, post-pandemic during that period where interest rates were at 0% for the Fed funds rate. And obviously mortgage rates were around 3% or less for some people during those periods, and everybody tried to lock in those loans. So credit quality, much better than it was back in 2007, big difference. Another thing impacting the market, mortgage rates. We look at the 30-year average mortgage rate around 7.5%. That's the highest level since 2000. More than 23 years. Why is that not hitting the market right now? Why is that not hitting the housing market? Well, all of those people, we just talked about the mortgage originations, all those people that refinanced, everyone that purchased a new home during the past 2.5, 3 years, they've already locked in their fixed long-term mortgage rates. And if you look at the effective rate of interest outstanding, this chart looks at the difference between the effective mortgage interest rates of people that already have a mortgage minus the current mortgage rate. Look at that lowest level that we've seen on this entire chart going back to 1998, not even close, down 3.6%. What that means is the mortgages of homeowners across the US, 3.6% less than that 7.5% average mortgage rate out there. So most people aren't feeling the pain of mortgage rates. And another reason why supply is so low, people aren't looking to sell their homes right now because they're going to have to buy a new home at a much higher interest rate. So that's really keeping prices high right now. Now take a look at the impact of the rate environment on the fixed income asset class. Let's walk through this chart. It's a really important chart, but let's walk through it. The y-axis is standard deviations percentage annualized. That's basically just the annualized volatility of various different parts of the fixed income market that we see on this chart here. So that's risk, right? The risk volatility. The x-axis, the horizontal axis on the bottom, is the return. What do you want? you want high return, low risks. You want that all the way to the right, and you want it down to zero. That'd be your perfect, impossible, non-existent asset class. Well, money market cash, not so far off from that. Take a look at this. You can see at the bottom there in the red circle, SGOV and VMFXX. What are those? SGOV is the short duration government ETF. The other one is a Vanguard money market fund. You can see both of those around that 5.25 to 5.5% yield with volatility essentially zero. Compare that to pretty much everything else on the spectrum, absent high yield there, USHY, high yield's earning higher yield but higher risk. Everything else is earning less yield with higher risk than cash. So cash isn't just a defensive position right now. Cash looks very attractive from a risk return, especially compared to much longer duration vehicles. Just to note the size of those bubbles, that's the length of the duration. You can see that real long duration, a lot of risk, not as much return as cash right now. Great risk versus reward in this market currently. And finally, a note for those upcoming holiday season, we're entering the fall period. We'll have the Black Friday, the Thanksgiving shopping season that kicks off post or right around Thanksgiving, runs through obviously the New Year time period. That holiday season could get impacted because of the Panama Canal, which connects the Atlantic and Pacific Oceans, is running into a bit of an issue with water levels because of a lengthy dry season and a short rainy season. They have a very unique water lock system that actually changes the level of the water to match ships transferring from the Atlantic to the Pacific. Very complex, but essentially takes 80 plus gallons or 80 tons of water to transfer those ships across that canal. Usually takes ships about 8 to 10 hours to fully get from the Atlantic to the Pacific or the Pacific back to the Atlantic. All that to say, because of the less water levels, a bit of a traffic jam there. Potential impact on delivery times during the upcoming holiday season, something to keep note of. Interesting development down Central and South America there. With that, I want to thank everyone for watching, and I will see you next time.